Today I'm going to talk about 1031 exchanges and the 1031 exchange timeline. If you've never heard of a 1031, it might be something you should know about if you want to save money on taxes when you sell your investment property. You may well think, well, I don't own an investment property, but if you had a house that you couldn't sell and you rented it out and you haven't lived in it for 2 out of the last 5 years, then that will automatically turn it into an investment property. So you have your house that you're living in and your investment property. What we're talking about now is what happens when you sell it. When you sell an investment property, you will owe capital gains taxes to the IRS if you sell it for more than you paid for it, which often happens if you've held the property a long time. You can defer paying these taxes by buying another property at least equal to the price of the one you're selling, and with a mortgage at least equal to the mortgage that you're giving up. That will defer the taxes. There is a whole list of things that you have to do, but it's very doable. I've done it several times myself. I've had clients do it, and it's proved very successful. What you have to remember is the timelines. When your first property, the one that you're selling, actually settles, then you have 45 days to inform the IRS from that settlement date of what property or properties you're planning on buying as the replacement property. That does not mean you have to settle within that time frame. It means you have to come up with the necessary properties. It can be more than one, and people oftentimes nominate more than one in case one of the ones that they nominate is bought by somebody else. You have to actually settle within 180 days of your dates that you sold your first property. That's 6 months, and there's no fussing around with it because it's got to be exact, and the IRS will come down on you even if you're a day late. There's a series of events that happens with the proceeds from when you sell your first property. Those proceeds have to be put in the hands of a third party. That's called the intermediary, and they hold them and they release them when you buy the replacement property. It sounds complicated, but it really isn't. It just adds 1 or 2 steps to a sale. But it will defer your capital gains, which could save you, $60,000 when you sell, or something to that effect, depending on your situation. Another good use of it is, which I've had clients do, is to buy your forever home in North Carolina or wherever you think it might be and rent it out. And that's an investment property. And then if you eventually move into it and live in it for at least 5 years, then you'll never pay capital gains on it when you sell it or when your heirs inherit it. So that's another thought about it. Your investment property in North Carolina, of course, would be in an exchange for property up here, which you're selling, your condo or whatever, that became an investment property. Please consult a tax attorney before you go into any of this, and of course, we will be pleased to help you with the latest information on these. We've done several of them. Thank you.